All right, today we're talking about liquidity sweeps. And I want to break this down as simple as possible because this is one of those concepts that once it clicks, everything about how the market moves starts to make sense. So in this video, here's what we're going to cover. What a liquidity sweep actually is, the key elements you need to understand for this to work, and then exactly how to trade it. So first, what is a liquidity sweep? A liquidity sweep is when price moves past a key level on purpose, triggers all the stop losses sitting there, and then immediately reverses in the opposite direction. That's it. That's the whole concept. Now, why does this happen, and who's doing it? Think about it like this. You and I can buy $500 worth of a stock with one click. No problem. But a big institution, a whale, needs to buy $500 million of that same stock. They can't just click buy, because the second they do, price spikes against them before their order even fills. So they need a massive amount of sellers all at once. And where are all those sellers sitting? Right below the swing lows, right where every retail trader placed their stop loss. So the whale pushes price down just below that level. Every stop loss triggers. A wave of sell orders floods the market. The whale absorbs every single one of them, and then price reverses straight back up. That's a liquidity sweep. The whale used your stop loss as fuel to get into their position, and this happens every single day on every single market. Key element number 1, the liquidity zone. So now let's talk about the key elements, because you need to understand each one of these for this to work. The first element is the liquidity zone. This is where the sweep is going to happen. Liquidity zones form at obvious price levels. The more obvious the level, the more stop losses are sitting there. The bigger the target it becomes. So what are you looking for? Swing highs and swing lows. Any clear high or low that price has made and moved away from sharply. Above swing highs, you have stop losses from traders who are short. Below swing lows, you have stop losses from traders who are long. Both of those are targets, equal highs and equal lows. When price hits the same level twice without breaking it, that's a massive pool of liquidity right there. Every trader is watching that double top or double bottom and placing their stops just beyond it, which makes it one of the biggest targets on the chart. One rule: the level has to be obvious. If you're zooming in just to find it, skip it. The best liquidity zones are the ones.
I want to talk about something that I think is actually perfect for anyone who's still learning to trade. It's called Alertsify. So what if you could actually make money while you're going through that learning process? That's basically what Alertsify lets you do. Here's how it works. There's a leaderboard of professional traders, and every single one of their trades is verified directly from their broker. Not screenshots. Not someone posting a picture of a green trade on Twitter. Actual broker-verified fills. Every stat, every trade, every result pulled straight from the broker. You can't fake that. And that's exactly what makes this different from every other signal service out there. So when one of those traders takes a trade, Alertsify auto-executes that exact same trade into your own broker account in under a second. Like literally under a second. By the time you even see the alert on your phone, you're already in the trade. And I know what some of you are thinking. $2,000 is a lot. And yeah, the Pro plan is a $1,997 founder's fee plus $99 a month. I'm not going to pretend that's cheap. But here's the thing. Most people make that back within the first month, just from copying the traders on the platform. They've got over $183 million in verified trading volume and $16.8 million in subscriber P&L on the platform. Those aren't made-up numbers. Those are pulled from real broker fills. Plus, it's got over 235 star reviews on WAP. So the results are clearly speaking for themselves. The link is in the description. Go check it out. Browse the leaderboard for free and see for yourself. And if you do decide to sign up, the link down below supports the channel, which helps me keep making these videos for free. Alright, back to the charts.
Any trader can see without looking hard. Key element number 2, the sweep. The second element is the actual sweep itself. This is what you're waiting to see happen. Price approaches your liquidity zone. Then it spikes past it, just barely, and then immediately, it snaps back. What does this look like on the chart? A wick. A sharp wick that pokes beyond the swing high or swing low and then closes back inside. That wick is the sweep. That's price going past the level, grabbing all the stops, and coming back. Now here's how you know it's a real sweep and not just a breakout. A real sweep. Price breaks the level and comes right back fast. The candle that broke the level closes back inside. The reversal is sharp and immediate. A real breakout. Price breaks the level and stays there. It doesn't snap back. It holds and continues. So watch how price behaves after it breaks the level. Does it come right back? That's a sweep. Does it hold and keep going? That's a breakout. That one difference will save you from a lot of bad trades. Key element number 3, the confirmation. The third element is confirmation. And this is the one most beginners skip. Don't skip this. Just because you see a sweep happen doesn't mean you enter immediately. You need to wait for one more thing, a strong candle closing back in the direction of the reversal. So for a bullish sweep, price sweeps below a swing low and comes back. You wait for a strong green candle to close back above that level. That candle tells you buyers stepped in. The sweep is done. The reversal is real. For a bearish sweep, price sweeps above a swing high and comes back. You wait for a strong red candle closing back below that level. That's sellers defending it. That's your signal. That confirmation candle is your green light. Without it, you wait. How to trade it. Now let's put it all together and talk about how you actually trade this. Step 1. Mark your liquidity zone. Find a clear swing high, swing low, or equal highs and lows. Draw a line at that level. Now you know where the sweep might happen. Step 2. Wait for the sweep. You need to see price spike past your level and immediately start coming back. Don't jump in the moment it touches the level. Wait for the actual spike and reversal to happen. Step 3. Wait for the confirmation candle. Strong green candle for a bullish setup. Strong red candle for a bearish setup. Closing back inside the range. That's your entry. Step 4. Place your stop loss. It goes just beyond the wick, below the lowest point of the sweep for a long trade, above the highest point of the sweep for a short trade. If price goes back past that point, the setup failed, and you won out with a small loss. Step 5. Set your target. You're targeting the next liquidity level on the opposite side, the next swing high above for a long trade, the next swing low below for a short. That's where price is heading after the sweep. That's it. 5 steps. Mark the zone. Wait for the sweep. Wait for the confirmation. Enter. Manage the trade. Call to action. Now before you trade this live, go to TradingView. Pull up any chart and just start looking for wicks that spike below swing lows or above swing highs and immediately reverse back. Start spotting them. Study what they look like. Do that for a week before you put any real money on it. And drop a comment below. Has price ever taken out your stop loss and then gone exactly where you thought it would? That was a liquidity sweep. I want to hear it. If this broke it down in a way that finally made sense, hit subscribe. Every week I'm breaking down one concept, keeping it as simple as possible. See you in the next one.